Credit Suisse Bank collapsing in 2023. What's going on in the banking industry? Credit Suisse, one of the largest Swiss banks and a global player in investment banking and wealth management, has been struggling for years with legal, regulatory, and reputational issues, as well as poor financial performance. In early 2023, the bank announced that it had incurred massive losses due to exposure to risky assets and fraudulent activities, and that it might not be able to meet its obligations to creditors and investors. This news sent shockwaves through the financial markets and raised concerns about the stability and resilience of the banking industry as a whole. In this article, we will explore the reasons behind the Credit Suisse crisis, the implications for the bank industry, and the possible solutions to prevent similar failures in the future. The Credit Suisse crisis, a tale of risk, fraud, and mismanagement. The Credit Suisse crisis did not happen overnight, but was rather the result of a series of risky and unethical practices that eroded the bank's capital, reputation, and trust. Some of the key factors that contributed to the crisis are: over-reliance on volatile and illiquid assets. Credit Suisse, like many other banks, has been investing heavily in complex and opaque financial products, such as collateralized loan obligations, CLOs, special purpose vehicles, SPVs, and structured credit products. These assets promised high yields and diversification benefits, but also carried high risks of default, downgrades, and losses. When the pandemic hit in 2020, many of these assets were hit hard by the economic slowdown, the defaults of corporate borrowers, and the liquidity crunch in the markets. Credit Suisse, however, did not have enough liquidity or capital buffers to absorb the losses, and had to liquidate some of its positions at fire sale prices, further depressing the market values of these assets and triggering margin calls from counterparties. Inadequate risk management and governance. Credit Suisse has been criticized for its lax risk management and governance practices, which allowed the bank to take on excessive risks without proper oversight or accountability. For example, the bank's risk models and stress tests were reportedly flawed and underestimated the potential losses from the risky assets. The bank's board of directors, meanwhile, was accused of being too cozy with the management and too slow to react to warning signs. The bank's regulators, including the Swiss Financial Markets Supervisory Authority, FINA, also came under fire for not being tough enough on the bank's risk and compliance issues. Fraudulent activities and cover-ups. Credit Suisse was also hit by several scandals involving fraudulent or illegal activities, such as the Archegos and Greensill cases. In the Archegos case, the bank was one of several lenders that provided margin financing to a family office run by Bill Wang, a former hedge fund manager who had a history of insider trading and other violations. When some of Wang's bets went wrong, the banks demanded more collateral, but Wang failed to deliver, leading to a forced liquidation of his positions and massive losses for the banks. Credit Suisse alone lost about $5.5 billion in this case. In the Greensill case, the bank was one of the main investors and enablers of a supply chain finance firm run by Lex Greensill, who was found to have misled investors and clients about the quality and viability of his assets. Credit Suisse was also accused of hiding or downplaying the risks of these investments, and of ignoring the warnings of its own risk managers and auditors. The implications for the bank industry. A wake-up call for reform and innovation. The Credit Suisse crisis is not an isolated incident, but rather a symptom of a wider problem in the banking industry, which is facing multiple challenges and disruptions that threaten its traditional business models, values, and roles. Some of the key implications of the Credit Suisse crisis for the bank industry are: loss of trust and confidence. The Credit Suisse crisis has eroded the trust and confidence of investors, clients, regulators, and the public in the banking industry, which depends on reputation and trust as its key assets. The scandal has also raised questions about the effectiveness and credibility of the existing regulatory and supervisory frameworks, which failed to detect or prevent the risks and frauds in the bank. As a result, the industry is likely to face more scrutiny, accountability, and pressure to improve its transparency, ethics, and governance. Financial instability and contagion risk. The Credit Suisse crisis has also highlighted the systemic risks and contagion effects of the interconnectedness and complexity of the banking system, in which a failure of one bank can trigger a domino effect on other banks, markets, and economies. The Archegos case, for example, affected several banks that were exposed to the same client, and could have led to a broader market disruption if the losses had not been contained. The Greensill case, meanwhile, showed how the supply chain finance model, which involves banks funding invoices of corporate clients, can be vulnerable to fraud, mismanagement, and conflicts of interest. These cases underscore the need for better risk management, stress testing, and diversification strategies to prevent systemic shocks and contagion. Disruption and innovation. The Credit Suisse crisis has also accelerated the ongoing disruption and innovation in the banking industry, as new players and technologies are challenging the incumbents and reshaping the landscape. For example, fintech startups are offering new digital platforms and services that are faster, cheaper, and more user-friendly than the traditional banks. Cryptocurrencies and blockchain technologies are also creating new forms of value exchange and investment opportunities that bypass the traditional banking channels. These developments pose both opportunities and threats to the banking industry, which needs to adapt and innovate to stay competitive and relevant. Possible solutions: a call for collaboration, transparency, and sustainability. The Credit Suisse crisis is a complex and multifaceted problem that requires a holistic and systemic approach to address. Some of the possible solutions that can prevent similar failures in the future are: collaboration and coordination. The banking industry needs to foster more collaboration and coordination among its stakeholders, including regulators, banks, investors, clients, and civil society. This can help to improve the sharing of information, knowledge, and best practices, and to align the interests and incentives of the parties involved. For example, banks can work with regulators and auditors to develop better risk models and stress tests that capture the real-world scenarios and interactions of the assets and markets. Investors and clients can also demand more transparency and accountability from the banks, and hold them responsible for their actions and decisions. Transparency and disclosure. The banking industry needs to improve its transparency and disclosure practices, which are critical for building trust and confidence. This can include disclosing more information about the bank's risk exposures, governance structures, compensation policies, and environmental, social, and governance (ESG) practices. It can also involve using more open and standardized data formats and reporting frameworks that allow for easier comparison and analysis of the bank's performance and impact. Sustainability and resilience. The banking industry needs to embrace a more sustainable and resilient approach to its business models, values, and roles, which are aligned with the long-term interests of the society and the planet. This can involve adopting more responsible lending and investment practices that support the transition to a low-carbon, circular, and inclusive economy. It can also involve investing in the bank's own resilience and adaptability through diversification, innovation, and risk